Well, we've seen a serious price dislocation in just about every asset class in last couple of days. The price action is reminiscent of what we saw in 2008 when things fell, they fell sharply. So when the selling happens, it reminds us of 2008. But post that, one must remember that if you really bought into the fear of 2008, you've made good returns. So is it time to participate in this fear? How should one try and connect the new reboot in crude market is because of coronavirus and the fact that a lot of impending issues, at least in the local economy, about Yes Bank, BPCL divestment, they're settled. So how should one really look at long-term investment planning in this kind of a scenario where it appears that bulls are on a strike? Prashant Jain joins us to walk us through his analysis of the way forward. Fantastic to have you back and thank you for joining us. We've got you at a very, very important turning point. The smile on your face is telling me that you think this is a buying opportunity. You're not that scared with the fall. Why is that?
No, one, I think the valuations have been good for some time, and the challenge what markets were facing is that certain stocks kept on becoming more expensive and what was cheap kept on becoming cheaper. I have experienced in my career thrice that every trend breaks only in a market's downturn, and in a way markets come back to sanity after such corrections. I think over the weekend several things have improved for India, and it's a good coincidence that all of it happened in a matter of days. One, the BPCL EOI has come, and I think that represents a very strategic shift from divestment through ETFs or OFS. The primary focus is now through strategic sales, and that means you will get a better value and there will be open offers of fairly large amounts. I think that's a very important shift. Crude prices have come down, which is always good for India. They may bounce back, but I think for the time being, for foreseeable future, they should remain low. Global yields have moved lower because of coronavirus. I think this fall in crude will also help that to some extent. And I think India at this point of time can do with lower interest rates. It will help in reviving economic growth. I think the Yes Bank issue has been settled. That was again a big overhang on the markets. And I think the way Vodafone has communicated that their assessment of the AGR liability, and Bharti has also done the same, I feel that even the AGR issue is likely to get resolved in the foreseeable future. So I think 5 very positive developments in this market. And valuations, as I said, were cheap in aggregate as well. And there is value to deep value in certain large sections of the market. So I do feel quite optimistic about these markets.
Okay, so I'll talk about all the factors one by one, but first let's understand the pace of the selling, the intensity of the selling. It reminds us of 2008. 2008 is when crude fell, US equities fell, there was sharp adjustment in financial crisis. How does one understand the lay of the global world? Because growth is going to be precious and many experts are saying that this will be a washout year for global economy.
See, I think in a way it could be India's year, because what does India really need from the outside world? It is lower interest rates and lower oil prices. These are two things what India needs, capital and oil, and both are very cheap. So I don't think the external environment could have been more conducive than this for India. I think India's growth as it comes back will stand out in this slow growth world. I think the government has done a lot by way of giving tax breaks to new manufacturing units, 15% tax break, and a tax holiday for infra investments by sovereign wealth funds. I think India should get reasonably large amounts of capital because India represents a large economy and it's an island of growth in the current environment. And even in the past, you see, whenever there have been challenges outside India, it has led to short-term corrections in the market, but it has not impacted the underlying economic growth. Whether it was 9/11, whether it was Lehman crisis, whether it was tapering or Brexit, whether it was Asian crisis. On each of these occasions, if you invested in India, I think these are good opportunities to invest, and I see no challenges whatsoever in the external environment. In fact, it's a myth and a wrong notion that India needs high world GDP growth for its exports to grow. India's share of world exports is minuscule. It is maybe 1 or 2%. So a country like India's, our exports, 80-90% growth is delivered due to market share gains and not due to the world economy growing. And we can look at what has happened in the IT industry or in the pharmaceutical generics industry. These industries have delivered 10-12% growth for last few years, and when they were smaller they grew at 20, 30, 50, 100% also. Now the world economy has never grown in double digits, but these sectors have been growing in double digits for 20 years now. So that clearly tells you that if you are competitive, a country like India grows, exports grow by market share gains and not due to world economy growing. And I think we are actually at a very interesting point of time because China is losing competitiveness in manufacturing. Chinese manufacturing wages are 1.5 to 2 times of India. And for the first time in my career, when I talk to companies in chemicals or in other areas, they feel that their competitiveness versus Chinese companies is quite good after almost 2 decades. So I think given the fact that we are competitive, given the fact that India is a very large economy, and given the fact that we have given a very concessional tax rate for new manufacturing units, and given the outcome of the coronavirus, which will highlight the excessive dependency of global multinationals on a single country supply chain, I think India should gain meaningfully in manufacturing, and I think in the next few years we should improve our share in global manufacturing significantly.
Now what we've seen in last 10 years is that liquidity has been abundant, very few companies have been growing and concentrated money has moved there. If your view of the world is dim and if your view of liquidity is strong, what stops more money moving into those 10, 15, 25 stocks? Yes, they were expensive, but they could become more expensive. They may not come back to deep value, and what is going higher may continue to go higher.
So it is possible, and that is what has happened for last several years. But there are no, what should I say? There are no, experiences that I have where the markets have continued to be less fundamentally driven over long periods of time. And let me give you a few examples here. Look at the pharmaceutical sector. It is down 70%. And everyone thought it is a consensus buy. These are great companies, these were great companies. But why did this sector correct 70%? Look at several auto ancillaries, look at several automobile companies. They have corrected meaningfully. Why? Because eventually the results disappointed you. And I think this developments around Yes Bank have implications for stock markets as well, going beyond Yes Bank and State Bank. I think, and this is what I have always said, that banking has two sides to it. One is the asset quality side and the other is the liability side. And you have seen serious dislocations in the NBFC space. And I think this has implications for the smaller banks as well, that you cannot disregard the liability franchise of banks, because that is what gives you real competitive advantage. So I think this event will bring some balance in the market's expectations on how to value businesses that have very strong liability franchise and the others who are yet to develop that franchise.
Okay. The way Yes Bank has been handled from a market standpoint, do you think that overhang is over? I'm not getting into why and how, not specific of stocks, but really as an investor, how would you view the rescue plan?
I think, it is, the challenge with commenting on a situation like this is that you and I know we have opinions, we have impressions, but we really don't know what were all the constraints And I am sure the regulator has applied their mind to the various aspects, and this is what they found to be the best solution. And I think the market was fearing that this bank will get merged into someone else. And I think that is not likely to happen. SBI chairman has clearly said that. And I think anyone who buys this bank at that 10 rupee price, what has come, I think at a 2,500 crores market cap, I think, and with very strong institutions behind it, I think this bank should survive. And I don't think anyone who puts in capital at this juncture is likely to lose money in this. But that is my opinion.
You've gone on record and you've expressed that you are now finding deep value in this market. You're using the word deep value perhaps after a gap of 3.5 to 4 years. And you've said that value is deep like 2001, 2002 when market conditions were very, very depressed. Where are these pockets of deep value, and do you think value investing will work in this kind of an environment?
Actually, earlier I used to say there is reasonable value, good value. But deep value is actually coming, to be honest with you, after 16, 17 years.
Exactly. I've never seen you
deep
use
value,
the word deep value.
I think deep value has come, we experienced similar values, deep values in early 2000s. Okay. When the whole world was focused on tech, anything in non-tech was dirt cheap. And in a way this reminds you of those times, because then crude oil was $10. And ONGC price, if you go and see, was extremely low, and today crude has fallen to what, $40 odd after 20 years. So I think there is deep value in this market for sure, and I think deep value exists in utilities, and I am finding such deep value in utilities for the first time in 2 decades or more than that. Please remember, the same utilities were valued at up to 4 times price to book exactly 11 years back. And then consumer companies were cheaper than the utilities. So I think utilities in India, they are not just utilities in the strict sense, they represent growing businesses. In Feb, the power demand growth in India was 7%, peak demand grew by 9%. I think India should experience high single-digit growth in power consumption for next very, very long period of time. So utilities in India are de-risked businesses because their P&Ls are quite regulated. You have long years of visibility. They are large businesses, they are dominant businesses, and they are growth businesses. They are trading around book value, below book values. You can buy them at dividend yields which are equal to or more than the bond yields. Now, if you can buy a large growing business with very limited balance sheet or operational risks at dividend yields which are equal to or more than bond yields, I think that's a very clear evidence in my judgment that there is deep value in these stocks. Apart from this also, I think there is value in certain corporate banks, large corporate banks, public sector, private sector. And I think this events like this will highlight the risk of smaller players in the same industry. And that is what I have always said, that focus on the leaders in any given industry, whether the industry is large or small. So I think even in oil companies there is deep value now. There is good value in banks. I find very good value now even in several EPC, construction, infrastructure companies. I think anything other than directly or indirectly related to consumption, I think there is good value to deep value. That's how I would put it.
So you're making a case that what we saw between 2003 and 2008, we are in that kind of a market where oil, commodities, construction, sectors and companies which in a sense started the cyclical upturn in the world, they will start making a comeback.
I think we are very close to that kind of a situation. Those days, I think we saw very sharp increase in capex. I don't know whether we will see that kind of an increase because but I think directionally, yes, I would say we are in a very similar situation.
The difference between 2003 and 2020 is that China emerged as a big guzzler. The appetite suddenly was insatiable for 10-15 years. where will this appetite and local risk will come from? Corporates right now are feeling scared, or they don't have the appetite or the money, and you don't have a large global economy which in a sense will do all the heavy lifting.
See, the only impact of China in that period was the sharp uplift in commodity prices. That is what happened, and crude prices moved up from $10 to above $100 in a 8-year period, and metal prices also moved up, and that could have led to some capex on the metal side in India. But for that, I think you can say these are very similar situations. But if commodity prices goes up, it is a mixed blessing for India. While it is good for the steel sector, but it is very negative for the country as a whole. So I don't think we are worse off. In fact, I would say that if commodity prices don't go up, if Chinese growth is not very healthy, it is probably a better situation for us, because oil is hard cash for India. And if oil prices remain low, I think it is extremely positive for us.
We saw a similar sell-off in crude in 2015-16, and that time inflation got crushed. And first we celebrated the decline in crude, then we realized, okay, because of crude, inflation has got crushed and pricing power also got crushed, and it took almost 3 years before pricing power made a comeback. Could we go through that patch where, yes, oil on paper coming down is great, but that will also bring other commodities down and pricing power down?
See, I think one, commodities by definition don't have pricing power. Two, I think crude is a very tough call to take, because while on one side electrification of the automobile sector is likely and crude oil demand could grow at moderate levels, but what low crude oil prices does to supply and to investments in new oil capacity is also cannot be ignored. Because please remember, the natural decline in an oil well varies from 3% to 20%. So if you add $45 of oil prices, very few companies would engage in long gestation, capital intensive projects. So I think I would not venture to say how will crude oil prices behave in the medium to long term. And you can argue if I think very low oil prices are also not good, because if oil prices remain very low, it can lead to some supply disruption, and that can lead to a spike. I think what would be good from an Indian point of view, if oil remains around $60, $70, at those price points, everyone makes money. Shale oil makes money, Canadian oil sands make money, deep oil makes money. So I think the supply does not get disrupted. Regarding pricing power coming back, I think we should just, the regulators, the central banks worry only about the core inflation, whether it is in US, whether it is in India. So these spikes in inflation or sharp falls in inflation around vegetable prices or energy prices, I think are rightly ignored or given less importance to by the central banks.
I'll ask you a very simple question. The price action is similar like what we saw in 2008. What is so different fundamentally about the world, and why should investors not panic and buy this fall?
So I would say, the India's, I think these markets are actually better than 2008, and I will tell you why. Pre-fall in 2008, India's market cap to GDP was bordering 150%. And markets bottomed out around 55 to 60% of GDP after a 50% fall. Those times, the leverage was extremely high in the system, and we were in the very early stages of a NPA cycle. The crude oil prices were also extremely high before they cracked. If you look at things today, we are at the other end. The market cap to GDP is close to the bottom of the markets after 2008. Our market cap to GDP is at very low levels. Our earnings cycle, our profits to GDP was a near peak in those times, and now it is, the bottom has been made probably last year. So earnings are clearly recovering. I think most people would agree that the corporate NPAs are now behind us. I mean, I don't have to say let's wait for 2 more quarters. I think they are truly and firmly behind us, and I think we will look at next year as a year of completely normal profits for the large corporate banks. Growth in India has bottomed out. See, last year growth was artificially depressed to my mind due to the sharp fall in production in automobiles because of the pipeline correction due to the move to Euro 6 norms. So the existing pipelines had to be run dry. Auto is about 5% of GDP in India. So when 5% of GDP, the production falls 20%, that's a minus 1% headwind to the automobile industry, to the GDP. Now, next year, even if production remains flat, that minus 1% is missing. So I think the GDP growth should be better in the current year. The IBC is truly behind us. And I think we are seeing very good resolutions in the power sector. Several have been announced, several are work in progress. So I think this availability of large number of assets in capital intensive businesses like power and steel also hindered new capex, because when existing assets are available at half the value, why should someone put out a new plant? So I think even that part is behind us. And I think the last bit is very interesting. See, this tax holiday which is available to new manufacturing units is only for 3-year period. The tax break for sovereign wealth funds in infra investments is only for 4 years. So I think these are limited period holidays, and I think because of this there will be a sense of urgency in global multinationals wanting to set up units in India, manufacturing. And also I think the India infra ready-made assets compared to the current prevailing low interest rates in the world will make very attractive investments. So I feel quite optimistic about the next few years. See, look at it this way, in the last few years we have handled almost large number of challenges, large number of difficult reforms are now behind us, and I feel the leverage is low, the NPA cycle is behind us, interest rates are low, our foreign exchange reserves are touching 500 billion. So I think the next few years I look forward to with great degree of optimism and confidence, not just for the economy, not just for the profits, but even for the stock markets.
Okay. Now, in your assessment, if interest rates will remain low, and if crude prices, you've been making a case in your newsletters that we will see a decline in crude, then indirectly Indian consumers will have more money to spend. Low interest rates, low crude, low commodity prices. Where does consumer discretionary, consumer durable, where those sectors and demand fit in?
See, I think you are right that, but I think this is also an opportunity for the government to probably increase tax collections around crude, because these low crude prices may not remain for very long periods, and therefore I think either through customs duties or excise duties, there is a possibility that government would like to consider to, yes, you should share some gains with the consumer, but please remember the fiscal deficits are also tight. They are relying on asset sales to fund investments in infrastructure. So I think part of these gains should rightfully go to the government exchequer, and that would help interest rates to fall even more, which is good for everyone. I think consumer discretionary is a long-term growth sector, but my judgment is in the near term, despite this fall in crude oil prices, we may not look at a very sharp recovery, because please remember the telecom prices have to go up, and what crude will give, maybe the telecom sector will take away, and the pricing in telecom sector had become so low that it was leading to unviability of businesses. And in any case, see, even in better environment last couple of years, we have seen very moderate growth rates in the automobile sector, for example. See, I think one trend which people have missed probably is the emergence of new consumption categories in last 2 decades.
Like?
Handsets, for example, mobile handsets, not the airtime rates. The mobile handsets is as large a category as the car market. Both are 2 lakh crores. Now, handsets are higher up in priority compared to buying a car. So I think there are new categories like air travel, eating out has gone up frequency, eating in has gone up, holidaying has gone up, spend on electronics has gone up, handsets has gone up. So I think in an environment where wage growth is modest, especially for the white collar workers, I think we should look at some more time before growth really picks up. Probably you have sensed, and I think others have also sensed, there is a shift in the way government wants this economy to move forward. And they are saying instead of simply borrowing and spending and increasing leverage indefinitely, isn't it better that you invest more, create more jobs, wages go up, and then you consume? I think if you earn first and spend later, that's a sustainable way of driving economic growth. And I think that is why we have seen so many tax breaks around investments in the last few quarters. And I think that is the right way to go forward going ahead.
I have 2 more very quick follow-up questions. As a fund manager, do you sometimes get frustrated when you see a stock like DMart, which was expensive, go from 600 to 2500, and a stock like ITC come down from 350 to levels of 200, even though it's deep value and generating a lot of cash?
So I think DMart is an outstanding business, and so is ITC, but there are challenges around certain around products. See, I would not like to comment on individual companies, but I think, as I said, at least I have done well in such situations. It takes time. See, I have experienced this, that outlier, or if you break away from the majority opinion, it can lead to some pain in the near term, and that pain period could be 1 year also, 2 years also. But if your assessment is right, then that pain is more than offset by the subsequent rewards. And I think equities is one area where the majority can be and is often wrong actually. And what you can do is something very simple. Look at last 2 decades, 3 decades, and figure out where was the majority opinion the strongest. Either consensus buy on a sector or consensus sell on a sector. And look at few years back what happened. The whole world wanted to buy tech, and it was non-tech which did well. The whole world wanted to buy infra, NBFCs, power utilities in 2008, and it was FMCG, pharma, automobiles with what did well. Pharma was a consensus trade 5 years back.
We sold a very early,
and see what happened. Look at small mid caps. Did 8 people, I am sure 8 people out of 10 were saying that smaller companies grow faster.
9 out of 10.
9
You
out of
10. Not saying.
So I think these are things which are markets can test your patience. But I have seen time and again that if your understanding is right, markets will come around. I have made mistakes, and some mistakes we have not recovered from them. But these have been mistakes where our assessment of the business was wrong. And till date, I am yet to come across a situation where even after 3-5 years, markets continue to be irrational. Thus far, it has not happened.
Okay. You know, I'm going to take the clock back of one of the interactions we had, and this was immediately after Brexit. Curtains were down on global growth. Nobody was able to understand Brexit. You came, we interacted, and you said 6 months from now, a year from now, Brexit would be a forgotten issue. So let's say 6 months or 12 months from now, do you think coronavirus and the financial impact of coronavirus will be forgotten?
I think coronavirus will pass. See, I think we are overblowing this situation. In a country of 1.3 billion people, 34 people have coronavirus. And China, which is so densely populated, that has managed to control, and you can see the progress they are making. And I think with the steps that are being taken, with the resources at the command of these governments, I am sure that, not sure, but I feel optimistic or confident that this situation will come under control. SARS and Ebola were far more, the fatalities were far higher, And if you read some expert opinion around coronavirus, and I read a 10-15 minute interview of 2 doctors from US, and they said the fatality rates in coronavirus are 0.5%. And bulk of those fatalities are people who are already hospitalized. So for a healthy, normal individual, the fatality rate is even below 0.5%. But in a way it is good that there is so much of fear, because people will take some cautious steps. But I do feel that coronavirus will actually, and I don't think we should think negatively, but logic says that it should work to India's advantage. Why? I mean, we don't want to be in an advantageous situation because of this, but this is the reality. One, interest rates should stay lower for longer now,
Which is a lot of liquidity.
which is good for India, number one. Number two, oil prices, whatever, because of coronavirus, the demand estimates have gone down. And even if these low oil prices don't remain, I think if demand outlook is weaker for oil, it means oil prices should remain moderate for longer. And I think finally the most important, please remember, China exports $2.5 trillion worth of manufactured goods. India is 300 billion, which is the same size as Vietnam, which is 1/10 our size. So if my wages are same as Vietnam, if they are half of China, if we are giving a 15% tax break on new manufactured units, if manufacturing is relocating out of China, why should they not come to India now? So I think India should see, after a long gap, I think genuine pickup in becoming a part of the global manufacturing supply chain, and coronavirus will drive a sense of urgency in the decision-making process.
Well, thank you for joining us. We always interact with you on these optimistic points, and you assure investors. Thank you for joining us. I've shaken hands. I'll send the sanitizer when you go out. But thank you for joining us. For the moment, it's back to the studio.